Hey, good morning. This is Chris, Coffee with Chris. It is Monday morning, 10 o'clock. So I wanted to talk to you about what the dollars are whenever you're buying a house or refinancing. So that's always everybody's first question. Oh my gosh, how much do I need? Oh my gosh, what are these costs? What is this number? What is that number? And so it's kind of it's very important, but it can also be kind of a panic thing, whenever you're looking at numbers. And we have found that, different financial people label closing costs differently. Whenever we're talking about closing costs, we're talking about the entire thing from start to finish. That includes any monies that you put out of pocket. That includes every single dime from start to finish. When you're looking at somebody speaking on TV, one of those online companies that are, oh, call us and we'll take care of you and we're going to give you and pay you, this cost and that cost, everything else. You need to actually read the fine print. Because there are certain things in there that they're covering, which a lot of times is points in some instances, but a lot of times it does not include the rest of the cost, which is you need 1 year of insurance. If you're a homeowner's insurance, in most cases, if you're buying, you have an escrow account, which is for your taxes and insurance. You have doc stamps, which is the state and county taxes. For lack of better words, I always call it like sales tax. So you have those different amounts on there too. You have title fees. And so we're going to go through those today, and I'm going to show you what those are and what they mean. But again, whenever you're talking to someone and they're saying, or you're hearing it on the radio, the TV, whatever, and they're saying, this is what your closing costs, we're going to cover X amount, X amount of dollars, whatever. It's most of the time not all of the whole thing from start to finish. So you may be blindsided. And so you have to be educated in knowing what exactly is covered, what to expect, all of the above. So that's what we're going to be talking about today. So let's get in it. I am going to share my screen here and get in this. So I'm going to use my little tool that I just figured out how to use here. So this is what's called a loan estimate. So a loan estimate you do not normally get until you have a property address. So there are 6 things that can constitute an application, which we've talked about that, I believe, in the past. So loan estimate is not given to you up front. You have to have those 6 things, including credit, income, address, loan type, and there's 2 other things just at the top of my head now. I just lost my train of thought. So anyways, you have to have 6 things. So you're not going to get a loan estimate just off the cuff whenever you are looking to buy or refinance. Refinancing, yes and no, but you're not going to get all of those straight up front. So what you normally would get up front is what's called, some people call it a fee worksheet. That's what we call it. It depends on what their system gives them. So closing cost estimate, fee worksheet, there's different things like that that can be done up front. But every house is different. So, just remember that too. Every house, you may have, different costs. So let's get in it. So this is my company here. Whoever you're using is going to be up there. Again, this is a loan estimate. These are good for 10 days. Okay. Because things change. So they're good for 10 days. This is the date that I issued it. I'm just using me for an example. My office address, the property address. So the applicant's address, this is where your address, your current address is going to go there. The property address is going to be here. Your sales price. So if you're buying, that's where this is going to be. If you're refinancing, then it's not. Loan terms, 30 years. Purpose, purchase. Product, fixed rate. There are adjustable rates. There is interest only, those kind of things or whatever too. So that's where this would be. Loan type. So this is conventional. So I'm doing the sample based on conventional. There's FHA, VA, and USDA. And then there's this box for other, which would be like an investment loan or different things like that. Loan ID is just your loan number. And then rate lock, yes or no. So in this instance, we're saying, no, the rate is not locked. In the crazy market that we're in as of now, which today is November 7th, we're, that's where you check with whoever's doing your financing, is your rate locked or no, so on and so forth. So it just depends on what's going on with the market. So we have a loan amount of 270 because what we did is I'm taking $300,000 purchase price and we put 10% down in this instance in order to show you because of mortgage insurance also. So we have 270 for a loan amount. We have an interest rate of 6.75. Interest rate, if we look at other Coffee with Chris's that we've done, there is several things that affect the interest rate. Calling to get an interest rate, just calling me and saying, calling me or somebody else, if somebody is giving you an interest rate just off the cuff, I don't know if I would, kind of bank on that, because there's too many variables. You've got your credit score, you've got your how much you're putting down, you've got your loan type, you've got your loan amount, you've got your property type. So manufactured home is more expensive than a single family home. A VA rate is less than usually an FHA. FHA and VA are pretty similar. USDA is right behind. Conventional is the highest rate in most instances. And conventional depends on how much you're putting down. So your rate could be a little bit higher depending on your down payment. So again, there is so many different variables to where it's not just something that you can say, hey, what's your going interest rate today? I will never answer that because it's a loaded question. Again, too many variables. If your credit scores are lower, then you're going to have more points, or your interest rate is going to be higher, or a combination of both. So again, it's not something that you can just get just right off the cuff. And if you're listening to those people on TV or the radio, then if you're watching TV, then pause it and read the fine print on the bottom. If you're going to websites, I go to websites and I look at other people's rates. And so there's a legal disclosure, whatever, that if you do the drop down, it shows you this rate is based on 74.09. That means you're putting over 25% down. And your score is based on this, and this rate is based on 2 points, 2+ points. So educate yourself and know what you're talking about. But if somebody is repeating a interest rate right off the cuff, there's more digging into it than that. So that's where this comes into play. So by a loan estimate, you've got all of those variables in place. Monthly principal and interest. Principal and interest only does not include taxes and insurance. So this is your principal and interest only. Okay. Can this amount increase after closing? No, because this is your loan amount. Interest rate? No, because it's a fixed rate. Again, up here. Monthly principal and interest? No, because it's based off of this loan amount and this interest rate. So your principal and interest cannot change. Your monthly payment can, in the sense that your taxes and insurance may go up or down. So, but in this instance, this cannot go down. And I am not able to, let's see, I need my mouse. Okay, there. So now we're going to scroll down here. So next we have, let me go back to my pen. So does the loan have these features? Prepayment penalty. In other words, if you win the lottery, if you get an inheritance, if you worked your butt off and you made lots of money and everything else and put money towards your down payment or towards your principal, if you pay it off early, is there a prepayment penalty? In most instances, there's not anymore, but you need to, that's what this means here. It's also called a demand feature. So the answer is no. Balloon payment, in other words, is your loan due in 10 years or is it due in 30 years? In this instance, this is a 30-year mortgage. So no, there's no balloon payment. Those are mostly for like hard money, or if you're doing interest only for X amount of time, but even still an interest only, like a line of credit that we do, is normally 10 years interest only, but it's still due in 30 years. So balloon payment, we don't have a lot of those anymore. Those aren't, as predominant. So now we have down here, so years 1 through 10. The reason why you have these different years on here is because we did only 10% down in this scenario. So you do have mortgage insurance for this conventional loan. So principal and interest, $1,751. which that is what we had up here in this. This is kind of going back and forth. So this is the same as to what's here. Okay. And then mortgage insurance, again, because we're only putting 10% down, this mortgage insurance is based on, again, different things like the interest rate. It's based on, is it a primary residence or a second home? Is it a single family or a manufactured? Is it, or what is your credit scores? What is your debt ratio? So there's different things that affect your mortgage insurance. So I've had people that absolutely have the money to put 20% down, but their financial person said, because the mortgage insurance in a case, for instance, let's say the mortgage insurance was $50 a month. It's cheaper to have the mortgage insurance, and in some instances you can write it off, but it's cheaper to have mortgage insurance than it is to take out money from retirement in some cases. So because mortgage insurance on a conventional loan is there until you have enough equity, used to be that you had to have it for a minimum of a certain amount of years, but that's not anymore. And there is a letter that comes with your closing documents that's in there too on how to get rid of it. But your mortgage insurance on a conventional could be that it makes more sense to put less money down than to pull out money from your retirement accounts. So that's, you have to weigh out the options and look at that. So again, in this scenario, we've got the mortgage insurance. So the system is estimating that by year 11, you'll have the 20% in equity. So now it'll go away. It most of the time does not take that long. You can pay down the principal balance, which is up here. If you go on a conventional loan, you do not need to refinance to get rid of the mortgage insurance, unless the values have just gone up dramatically. And you can't use, and again, this is where your letter will tell you as well, you can't really use the equity that you've gained in a short period of time to get rid of the mortgage insurance. It's, read the letter that's with your loan package and get with your financial person on that. It'll explain it further. And then escrow amount, this is your taxes and insurance, which is your property taxes and your homeowner's insurance. People call it hazard insurance also, but it's in the general scheme of things, it's homeowner's insurance. So that's what this is. So we take your principal and interest, your mortgage insurance, your escrow. So this would be your estimated total payment out the door. And so this is what you would write a check for each month to pay your mortgage payment. The best way for me to describe this is your principal and interest goes into your left pocket to pay your your mortgage. Your mortgage insurance goes over into your right pocket, and that goes to pay the mortgage insurance. And then your escrow goes over into that right pocket also, because that is to pay your taxes and insurance every year whenever it renews. So in the state of Florida, our taxes are due on November 30th, if that's whenever your mortgage company pays it by November 30th, so you get a 4% discount, so on and so forth. But so that money is here and in your escrow account, to where again you're making the $2,400 payment, and your mortgage, your bank is paying the taxes and insurance renewed for each year. So if we were closing on you, if you closed on a house today, which is November 7th, and you're buying a house, your insurance would be due would renew like an auto policy November 7th of 2023. And so you're making the payments every single month to accumulate for that payment being due next year. Same thing with property taxes. So being that this is November, our property taxes are due at the end of this month. And so if you're buying a house, then most of that money comes from the seller because they've owned the house for just about all year. And then your escrow payments are going to start to prepare for next November. So that's how escrows work here. And we're going to go into that a little bit more on the next page. So again, you would make your total payment for this amount. Okay. And so then we go down here. So this is saying that the estimate includes property taxes. There's a checkbox here. It includes homeowners insurance, and the total for those is the $550. If you have an HOA, It may say HOA here, but it's not included. It would say no in here because HOA is not included. Homeowners Association is not included in your escrow. You pay that separately. So this is saying in escrow, so your taxes and insurance are here. That's what that means. You may have, well, your mortgage insurance is in here, but it's not considered a escrow account like your taxes and insurance to make a payment outside. So it's a little bit different. So we have estimated closing cost is $18,595, which again, we'll go through that in just a minute. Your total estimated in this scenario, cash to close is 42. This amount, with the way that the government has done the loan estimates, this amount includes every single thing from start to finish. It's not what you're going to bring to the table. This does not include your down payment. So in this scenario, 30,000 was your down payment. And so 30,000 plus the I'm sorry, not 30,000 because I have credits in here. But this is your total, your down payment plus your balance of your closing cost is what this is. Okay. So we're going to go to the second page. If I can get my mouse. Okay. So this is your detail of everything. So origination. So origination can be a number of things. And so you kind of look on here to see what all your stuff is. So you may have points. So right now with this market, you normally do have points. Some finance companies, some banks, they have an application fee, they have processing, they have underwriting. So all of that in my eyes is still all in the same realm of points. And so for this presentation, for this video, we're putting it, we personally do not have those different amounts. But if you're comparing apples to apples, this is the number that you're looking at because other places may have those, some places do not. So again, this is the number that you're looking at to compare. So points can be, and this is where you get with your accountant, can be tax deductible. Sometimes it is worth paying points in order to get your interest rate lower. It has to make financial sense. So you need to make sure that the numbers, is it more cost effective for me to do a higher rate because maybe I'm in an FHA loan, and so the FHA loan, in my opinion, is a short-term loan. You don't want to stay in an FHA loan for 30 years because you have the mortgage insurance for 30 years. So if your mortgage insurance is $100 a month, that's $36,000 because it's $100 times 360 months. So for me, if I'm doing an FHA loan and you're limited on funds or whatever, we may do a higher interest rate to lower your cost, okay, which your higher interest rate would lower this amount normally. So we may do a higher rate and a lower cost in order to save you money out of pocket because we are preparing for a refinance later because you may, and again, the FHA loan is I don't know why that keeps on going off. An FHA loan is, in my opinion, the last option that you have. And so, or that you want to do. But there's different reasons why you use that loan. And in a past class or video, I have talked about the different loan types. And so you can refer back to that as far as why and what my feelings are, in other words, to do that. So again, origination, that's going to be your points, your admin, your underwriting, processing, whatever your financial company has. For our company, we just have this one spot normally. And that's normally all there is. So then you go down here, services you cannot shop for. So again, the government redid this form. And so this is, appraisal fee. This is an estimate. So if your actual appraisal fee comes up to $700, then you're going to get an updated loan estimate saying $700. Credit report fee, $100. Again, these are all just estimates. Flood certification, because you have to make sure that your home is not in a flood zone. And if it is, then you have to have flood insurance. Tax related service fee. This is because there is a third party that confirms that your property taxes and your homeowner's insurance are paid each year from that escrow account. So that's what this is. It's one time, it's not continuous. verification of employment, you may have that if your employer requires us to go through a third party to get a verification of employment. So you may have that. Some companies, like myself, if somebody were to call for verification of employment on one of my staff, then I physically do it. So there is no charge. It just depends on your company. If you're at a Walmart or a Publix or a hospital or, a big corporation, then they may have the employment verification there. And then scroll down here. So this is services that you can shop for. Okay. So home inspection, you can shop for a home inspector. Pest inspection. So this is something that you can choose who you want to use for a pest inspector. But some loan types require it. So home inspection is not required 99% of the time, 99.9% of the time. A home inspection is not required for a loan. It is strongly suggested, but is not required for a loan. A termite, which is also called a pest inspection. If you're doing a VA or if you're doing a USDA, the pest inspection may be required. Some loan conventional does not. So in other words, it is your choice of who you choose to use it or to do that inspection. But some loan types do require it to be an inspection. Some require for it to be done and some don't. Septic inspection. This is again your choice of who you use. That's the point of this, is that this is your choice of who you use. So septic inspection, this is to check to make sure your septic is good and working and everything else. We always strongly recommend this being done. We've had people that closed and then 2 or 3 days later, oh my gosh, the septic isn't working. It's going to cost me $10,000. There's nothing you can do after closing. So we strongly suggest you having it done. This is again, just estimates. So your area may be different. Okay. Survey. So we've talked about this before as well. And so a survey is not quote unquote required for a loan, but the title company cannot have an exception. The bank does not allow for an exception. Or I'm sorry, I said that wrong, I think. So a title company will have an exception if they do not have a survey, because they need to see the boundary lines and neighbor's property's not on yours, so on and so forth. But the bank cannot accept an exception. So it's not allowed. So therefore, one has to accept or have to have an exception. The other one does not allow for it. So to solve the problem, you have to have a survey. Again, depends on, the company that you use. We, as a courtesy to our clients, get a quote from a couple of different survey companies, because some may be further out in their scheduling than others. Some don't do a certain area, so on and so forth. So we kind of have a database as far as that's concerned. Again, you can use whoever you want to use. Title. So title, we've done some past podcasts with title companies. So again, this is just an estimate of their fees. They have different things. They're issuing a lender's title policy. Over here, they're issuing an owner's title policy. So you can choose, as far as Florida is concerned, you can choose, but if you choose versus the seller normally does choose, but you can. So if you choose, then if you choose the company and not the seller, then you may be paying this amount over here, and you may be paying another amount over here, which I'll show you in just a minute. But that's a part of, your negotiation and your discussion with your real estate agent. Water testing. So water testing is if you have a private well, and that is to make sure that there's no coliform in your water, bacteria. And so this is a choice, whoever you use. Some counties, you can go to the health department and they have kits and everything to do it. You can hire a company outside. So it's not required for a loan except for a USDA and VA loan. No other loan requires it. Again, it's your choice, but it's your choice who you use is what this section is. Some of these things are required, some are not, but it's your choice who you use is the key. Okay, and then so we take these numbers down here. We take this number, and this number, and then we scroll down here, and that is what this number is here. Okay, Then we're going to come up. I'm just looking at my other screen for my mouse. Then we're going to come up here to the top right. And so then we have what's called other cost. So other cost, here's your recording fee. So recording is recording your mortgage, which is not your financial information. It's saying to the world that there's a lien out there. We've talked about that with title companies and stuff. And it's also your deed. Your deed is like a bill of sale that you're buying the house. Like if you're buying a car, you get a bill of sale. So that's kind of what a deed is. It tells who's on title, and that you own the property. Transfer taxes. So transfer taxes in this scenario, this includes the transfer taxes for the state as well in Florida. So we kind of disclose this up here, whatever your taxes may not, this may not be that high, because the seller, if the seller chose the title company, then normally they pay for this amount. But in this scenario, we've got it up here because if I don't disclose it, then I'm in trouble. So that's why I, cover myself or whatever, because if we don't have a contract yet, we don't know who's paying for it. So the transfer taxes, to be in the easiest words is, it's kind of like sales tax on buying a house. So there's doc stamps for the county and also state. There's doc stamps for the deed and then also the mortgage. So the doc stamps on the mortgage you pay for as the buyer, new owner, if you're refinancing. So you are buying you're paying the doc stamps on the mortgage. If you are buying, then the seller normally pays the doc stamps on the deed. Down south, in South Florida, that's not the case. So again, I do all over the state of Florida. It depends on who's doing your financing. So this may be an amount that you do have. Again, it depends on the contract. And that's where your real estate agent can help you on that, because that can be a big cost. If you're building a new house, then normally you pay those doc stamps. So if you're buying just land, it could be doc stamps just on the land price and not the build price. If you're buying a new build in a community from a production builder, like a Lennar Homes or one of those, then you may be paying the doc stamps on the mortgage or on the purchase price, which is the whole entire thing. So again, conversation with your real estate agent, but that's where we disclose it up here. Next, we have prepaid. So your prepaids are things that have to be paid up front. So if you're buying a home, we have to collect for 12 months of insurance in most cases. On an investment, you have different options. So on a refinance, if you're already 6 months into your policy, then there would not be anything here. So this is if you're buying a home. And again, in this scenario is if you're buying a home. So we're going to collect for 1 year of insurance up front. And then remember, your payment includes your escrow to prepare for next year. Okay. Prepaid interest. So this depends on the day that you close. So we always disclose 30 days because if we don't know when you're going to close or whatever, if you close on the 15th of the month, then this is only going to be maybe 15 or 16 days. So this amount is going to change here depending on when you're closed. So if you were to close today, November 7th, then you may have, say, 23 days of interest here. And then, so 23 days of interest for November, no payment December, your first payment is January. That's normally how it goes. That's how we do the numbers, but that's normally how it goes. So in this scenario, we're collecting 30 days of interest, no payment November, for no payment because your interest is paying for November. Interest is paid in arrears behind. So we're collecting for interest in November, no payment December, first payment's January 1st. Okay. Then we have initial escrow payment at closing. So what this is we're estimating in this scenario, again, $200 for homeowners insurance. So this 2 months is to prepare for next year. This is paying for the 1 year policy from November 7th of 22 to November of 27th of 20 or November 7th of 23. This amount here is collecting for the 23 to 24 premium. And so that's where your payment is going to go into that account on the right side, right pocket, to accumulate for the premium for next year. Then you have property taxes. So property taxes, your net whenever you go to closing, your net is usually going to net about 5 months. So that's why I put this here. That's what I have always learned, understood, been trained as, educated as, and it always is pretty accurate within a month or so. So again, the seller pays for property taxes from January 1st until the day of closing, and then you pay for the rest of the year. So I always put a net of 5 months. At closing, this may be 13 months, but then you have a credit from the seller. So this is a net number in order for the purposes of estimating closing cost. So then that's where you've got this 1750. And by the way, all of these numbers roll up to here. So this number rolls up to here. So it's kind of different as far as math is concerned. These numbers equal this. These numbers equal this. So it goes up. So this is the total, and this is the breakdown of the total. Think of it that way. Real estate transaction fee. So some real estate agents, their office has a transaction fee. So that's what this is. It would be on your contract. Your real estate agent would explain that to you. Title owner's coverage. Again, that's part of the title work. This is the title company giving an owner's coverage, meaning to you as the owner, that everybody else's stuff is free and clear before you. I call it everybody's crap before you is free and clear. So they're giving you the property free and clear of anything that has happened from that day backwards, that there's nothing that's going to attach to your property, like somebody else's judgments, liens, anything like that anybody can come after them for. So then we take these numbers here, and that is where this number is here. Okay. And then we're going to scroll down. And this part is kind of confusing and it doesn't show everything. And that's where, you know, my not so happy or whatever is that these loan estimates, they don't break this down a little bit more. So this number here is a total of this and this. So this is your left side, this is your right side, and this is the total of both. If you have a lender credit, then that's going to be here. Lender credit is what we used to be able to do all the time, and that's where I would give you back points. So that's what that is. And so that's where that would be. And so if this was, say, for instance, 2,000, this would be 16,000 and change. Okay. So then we have this number comes down to here. So total closing cost. This number also was on the bottom of that second page. And this is where I'm telling you that those numbers. So if we go back here, this number is up here, but it's not your total because you have other things going on. So now we come down to here. So we have closing cost here. We have your down payment of 30,000, which was 10% of your purchase price. Your deposit, which is your escrow deposit. Some people call it a good faith deposit. That goes to a title company normally or to a builder to say, hey, don't sell this house to anybody else. I want this house. So that's what this amount is. It goes towards your closing cost and your down payment. Then we have seller credits. So this is, I put this in here as if a seller were to give you seller concessions. So that's where that comes in. Seller concession, meaning the seller paying some of your closing costs. Again, that is a conversation between your finance person. Do you need that money? But also it is a conversation, most importantly, with your real estate agent, because that is part of negotiating your contract. So that's what this is. Now this adjustments and other credits, this 2,700, this is where I had estimated as far as in this scenario, if you're paying the taxes, the dock stamps on the state tax. So this 2,700 includes 600 here, which if the seller chose the title company, the seller normally pays this. Again, it's based on your contract. And then also it is part of this transfer taxes, which is 2,100 in this instance. So Florida has a calculation is the purchase price, which is the 300 times 0.70, which equals 2,100. So I took the 2,100 from here and the 600 from here, which includes, I thought I turned that off, the 600 from here, which is this 2,700. So this is where you're going to see credits. Now, one big thing with a loan estimate that I have clients tell me all the time anyways is, well, I paid for this. Why is it still here? I paid for this and this. Why is it still here? I paid for the appraisal up here. So why is it still here? the law says that I have to still keep this here, even though that you paid for it, because it is a cost to buy a home. So therefore it does stay here, okay? But it is credited off down here. So you may see adjustments and other credits. So this 2,700. So if you paid this home inspection of 400, you're going to now see 3,100 here. Your bottom line of this is going to reduce. So that's where, you know, this adjustments and credits, that's where this number is going to grow throughout your process. So that's where that is, but it has to stay here. We have the conversations all the time. It's just how the government put the forms. And so they're saying, here's the total cost of buying a house, but then here's all your credits down here. Okay. I'm sorry, but we don't have an option. Okay. So now we go to the third page. So this is saying, what this is saying is that in comparison, so use these to compare with other loans. So total you have paid in principal and interest and so on and so forth. So after 5 years, then this is how much you would pay. Principal, this is how much you would have paid off towards your principal. Annual percentage rate. This is where everybody gets stuck. Okay, so in this scenario, I had said that your interest rate, I'm going to scroll back up here, that your interest rate was 6.75, okay? But then you had a little bit of points, which is here, okay? So now the easiest way for me to explain this, the annual percentage rate, is that the easiest way for me to explain this number to you is that if you take your closing cost plus your loan amount divided by 365 days for 30 years, this is your average rate. That's not what you're making payments on. So that's key. So if you make extra payments towards your principal, this is going to be reduced. If we refinance you out of an FHA into a conventional, this is going to change based on that new loan. So this is what that number represents, for lack of better words. And again, it says right here, this is not your interest rate. So people will call me and say, well, what's my APR? Okay, let's stop for a minute. Let's talk about this. What is it that let me explain to you everything. And again, that's where you go back to, okay, what is my interest rate? Well, there's a lot of variables on the interest rate. Okay. And then do you have points? Do you have this, whatever? And mortgage insurance comes into place here, like on a FHA or an FHA loan, mortgage insurance, funding fee on VA, and USDA has a guarantee fee. So that's also part of these costs that are included in here. Total amount of interest that you will pay over long-term, percentage of a loan amount, 134%. So in other words, if you take your loan amount times 134%, that's what you're going to be paying. Again, the whole key is to make extra payments towards your principal. So if you make one extra payment, so let's say in this scenario, and this is not exact numbers. So let's say, for instance, in this scenario, you made one extra payment of $1,700. That's principal and interest. So the philosophy is principal, but I like to just say, you know, put a slush in there. So if you made one extra payment of $1,700 a year, whether it's monthly, whether it's every couple months, whether it's one time a year, it doesn't matter how much it is over the long term. I've done the math and it's only about a month and a half difference. So if you take that and you do that every single year, it'll take off, depending on what your interest rate is, could possibly take 5 to 7 years off your mortgage. It could be more. So that is key. Do it. Put extra money towards it to where you can pay your mortgage off easier, quicker, all of those things. So that's what that is. And that would reduce this 134 number. So down here, this is other considerations. And so this is saying appraisal, we may order an appraisal. So sometimes we can get what's called an appraisal waiver. So again, we may have an appraisal assumption. This is meaning that, and again, this will change according to your final documents, your final closing documents. This is saying that mother, brother, and sister can, in this scenario, in my preliminary, cannot assume the loan. In other words, they cannot take over payments and make the payments for you. There's something else in the background of that or whatever that is releasing the personal liability. That's a whole nother conversation. Most of the time loans are not assumable. VA and FHA, sometimes they are. Bottom line is you don't want to have somebody take over your payments unless they're going to be financially responsible, because if they get foreclosed on and you're still financially responsible, the bank's coming after you, doesn't matter. Homeowners insurance. We will have homeowners insurance on the property. Homeowners insurance is to protect you, but it's also to protect the bank because they're lending you on that collateral. Late payment. This is just preliminarily. Normally this is 4%. So if you make your payment after 15 days, then there's normally a 4%, not a 5%. This is just, again, a sample. Refinancing this loan would depend on your future financial situation, the property value, and market conditions. You may not be able to refinance this loan. This is saying that refinancing, if this was an FHA loan, yes, we can refinance you, but it depends on, do you have a job? Can you afford the payment? Is the value still there? Property value and market conditions. Market conditions is kind of, in my eyes, the same, in the same realm as property value. So if you're in an FHA loan for, let's say your credit score is lower, then you have to bust your butt to get your credit scores higher in order for us to refinance you, to get you into a lower interest rate and to get rid of that mortgage insurance, which, again, the scenario that I had said earlier was $100 times 360 months, which is $36,000. Why give that money away? Put it towards your loan. So credit scores are very, very important. Servicing. So I am a mortgage broker. Again, it depends on who is doing your loan, whether they service it. In most cases, your loan is sold. If your loan is sold, then, so my documents are always going to be saying that I transfer it, because I do not service the loan. You do not make the payments to me. So if you're going through a big bank, theirs may say that they're servicing it. They can still sell it. So they may sell it, 4 or 5 times. So that's what that means. Loan acceptance. This is saying that you do not have to accept the loan, that you have received, you've received this form or a signed loan application. In other words, we're starting the loan, your loan application is done, you have those 6 things to constitute an application, and so that's where you're getting a loan estimate. That's what that means. So this is what a loan estimate means. This is the ins and outs of it. This is the numbers of it. These numbers will constantly change during the process of you buying or refinancing. Your key is, for me, for my clients, I tell them this is the main document that they need to look at. This is the keys to the kingdom. This is what says, okay, I've updated your payment because we got the insurance quote, so on and so forth. So this is the form that is most important that you're looking at throughout the process. This form then at closing turns into what is called, a closing disclosure. Okay. So again, this is the form that you're looking at during the process. This is not the form that you're going to get up front before you have a property address. That's a closing cost, or that's like a fee worksheet or whatever. It may look similar to this. Mine looks similar to this, but this makes it easy to where that you know what you're looking at through the process, where your eyes are going, all that kind of stuff. So I hope this helped you as far as where the numbers are, what they are, and what numbers to look for whenever you're buying or refinancing. So I like to educate. And so here is your education for the week, or for 5 years from now, who knows? So this will be posted on all of my social media, my YouTube, everything else, and on our Coffee with Chris Live. So if you have any questions, you make sure and comment. Please subscribe if you're on the YouTube. Like, share, all of the above. If you are a real estate agent and you've got somebody buying, this will help to, answer a lot of your questions, or your clients' questions. So please share. We love to be shared. We love to be, liked and subscribed and all that kind of stuff. So I hope you have a great week, and we will talk to you soon. See you next Monday. Bye. I think. Let me see. Stop my share. Here I am. Okay. Sorry. So have a great week. Talk to you later. We've got one of my, we'll be posting tomorrow to say who's going to be on for next week. Have a great week. Make somebody smile. Okay. Bye.